Michael Williams. I'm the President and CEO of Vendetta Mining. What I'll do is briefly take you through what's happened in the past year and what we expect or hope to happen in 2018 going forward. Total cash we've raised for the project is currently at $9 million. $6 million of that has been put back into the ground. When we originally acquired the project in 2014, we had 5 million tons in ostensibly a historic resource, grading 9% lead zinc. The project's located in Mount Isa in Australia. At that point in time, what our internal business model was on our mine plan, we thought if we could get to 15 million tons underground mining, we could start to apply economic parameters to the ore body. Now, there's been several changes since then and several key changes within our technical team and our management. What we then thought is, based on our 2015 drilling, that we would have an underground resource with a 2 to 3 year, perhaps open pit, starter pit moving forward. But as of last year, and we put out a new resource in June, it looks like the majority of the ore body is going to be open pittable. And that's a key factor moving forward. It really improves the economics, and in a lot of cases, I think it de-risks this project. So as we move forward now, our mine model is to demonstrate as much ore as we can in the open pit shells, which we hope to demonstrate shortly that we're going to hit 10 million tons with a further 5 underground. Now, we've also done our preliminary metallurgical testing. That's all come back positive. We have a marketable lead and a zinc con, and that's our preliminary test work. As we optimize it, we expect to see improved recoveries and met work. Our resource, as I mentioned, was initially 5 million tons. As of June, it's just a shade under 13 million tons, with approximately 75% of that being in an open pit shell. We've increased it by 75% in the inferred category and 44% in the indicated. We've also made a new discovery called the Bridge Zone. That was discovered in September, just 2 days after the previous MIF show. And our target there is to prove up another 750,000 to 1.2 million tons and add that to the resource. It's not included, obviously, now. As far as share structure, we currently have 119 million shares issued and outstanding, 167 fully diluted. Management has a 7% ownership position. Resource Capital Fund continues to be our largest shareholder at 16%, with Solitario Zinc Corp has just recently increased their position to 8% from 6%. And as of September, we added Zijin Mining, the large Chinese mining company, base metal and precious, have approached us for a 10% interest in Vendetta. We felt comfortable with a 5%, and they've since acquired that position. And as of last month, we have analyst coverage from George Topping at Industrial Alliance, which is a large retail and institutional securities firm in Toronto. They have approximately 800 brokers. Everyone on our board has either been involved in the financing, monetizing, and development of these type of assets worldwide. So I think we've got the team necessary to bring this project to fruition and to finance it in the next 24 months. I'll just quickly touch on lead zinc. I'm sure some of the other people like Eric have talked about it in greater depth. This is the market we've been looking for. We talked about it. We're at 10-year highs for zinc. The last time we saw a market like this was 10 years ago. I think this is the one we've been waiting for. Lead and zinc, after copper and aluminum, are the highest used non-ferrous metals. And what we're seeing is there's still maintains some supply issues. The treatment charges and refining costs at the smelter level are at all-time lows, which is good for the mining companies. So I think moving forward, we expect to see these prices or even higher prices. The inventories are trending down. So everything is going in the right direction from the commodity point of view. But I will say this, we haven't seen a corresponding increase in the valuation of the companies since the increase in the commodity price. in the last 6 months to a year. When we originally put this project together, we were looking at metal prices around 90-cent lead and 95-cent zinc, which is what we model this project at to stress test it. It's since increased by 50% and 40%, and we just don't see that increase in the share prices and valuations associated with the various mining companies, from the producers all the way to the juniors. And I think one of the issues surrounding lead zinc is there's just not a lot of stories out there. There's not a lot of good stories that can capitalize on an increased zinc market over, say, the next 24 to 36 months. So we haven't seen any comparables on the M&A side. We haven't seen any new takeovers, but I suggest that's coming shortly, because once the earnings start coming in from some of the producers, it trickles down to companies such as ourselves. Location. This is sort of why we went into Australia. Well, it was twofold. One, we wanted a safe political environment. Australia provides that. And second, it was the infrastructure associated where this ore body is located. It's in the Mount Isa mining district, which is considered one of the top 3 in the world. And what's ostensibly happened since this discovery was made in 1972, the infrastructure has built up around it now. If I can... pointer. Cannington, which is owned by a company called South 32, which is a spin-out from BHP Billiton. That's about 28 kilometers from Pegmont, as the crow flies. It currently mines, it's one of the world's richest silver lead mines. At one point, it was the world's richest silver mine. It's on a declining grade curve. They initially started mining at 580 grams per ton. They're down to about 220. Now, they mine at a rate of 3.2 million tons per annum, but because they're on this declining grade curve, they've decided to ramp up their mill size to 4 million tons. And in order to get that, they're looking at an open pit scenario. They're confined underground by their shafts. Now, if they were to go into production on an open pit to go from 3.2 to 4 million, their grade would drop to about 70 grams per ton silver, and they have half the lead zinc that we do. But the key tenet is that our ore is worth about double the NSR as theirs. So I think we'll be having discussions with them in the new year. We'll be in Australia next month, and they're one of the companies we will be meeting with. Now, just over 25 kilometers equidistance by Osborne, that is owned by a Chinese company called Chinova. They currently mine at a rate of 2 million tons per annum. They're out of ore in February. I think Pegmont could certainly be a supply. It's currently a copper mine. It would take about 15 million of upgrades to their concentrate facility in order to run lead zinc. So that's another opportunity that we might look at moving forward. And we're going to see if the availability of their particular infrastructure, if we might be able to purchase it once again as we go over to Australia next month. Now, there's a rail line that extends from the Mount Isa district to the coast. At the coast, we have a zinc smelter owned by Korea Zinc. It's under capacity. They're currently getting concentrates in from Peru to fill it. That's about a day's trip from Pegmont to the coast by rail. Would take less than a day, and it would be at their facilities. Korea Zinc has already said that once we get to the PEA level, if we want to talk to them surrounding an offtake agreement, they would help us get the project over the line. If we were to, and this is in our internal studies, we think the capital expenditures required to put this project into production would be if one of the local mills at Cannington or Chinova would be worth to them about 60 million capex. If we were to go standalone, 120 to 140 million, which by today's standards I think is reasonable, and given the infrastructure, certainly I think we've de-risked the project once we get to 10 million tons and 5 underground, bearing in mind that the first 10 years of mine life would all be open pit. I show this slide. This is Vancouver in 1880 versus where we are now, and the importance of infrastructure. This is similar to how Pegmont was in 1972. There was nothing there. Now there's a significant amount of other mines have been built up around the region. which it gives us a competitive advantage, I think. If we didn't have the infrastructure that we do, I think we would need another 24 to 36 months of aggressive drill programs before we could demonstrate the economics of Pegmont. As it stands now, we intend to do that next year. So Mount Isa is located 5 hours by truck. It's a lead smelter. It's under capacity. The haul roads, there were $1 million from hooking up to the haul roads that will allow us to either go to railhead, to the local smelters, or to the mills in the area. The Port of Townsville is also a deep sea port. Its primary focus is for metal concentrates. If we decided that the concentrates would be better served to go to Asia or to the south of Australia, we can certainly do that through Townsville. And once again, that's a day's journey by rail. The resource currently sits at, on our open pit is 2.1 in indicated and 6.3 in inferred. And then our underground is currently sitting at 3.3 million tons inferred. I was asked earlier today what would be, and I don't normally like to use it, but just to give you an idea how valuable I think this ore body is, primarily the open pit component, because that's what we're going to be focusing on. If this was a gold deposit using today's gold rate and we used $1 lead and $1.10 zinc, the open pit component, or the 10 million tons, would be equivalent to 1.5 million ounces gold deposit, grading 5 grams per ton open pittable, and those are key economics. The overall size would be around a 2.2 million ton or ounce gold deposit. So that sort of gives you an idea of the robustness of this lead zinc asset. And one thing that I should point out, and Patrick mentioned they're focusing on oxide gold. On the base metal side, and primarily in lead zinc, you do not want to focus on oxides. We do have an oxide component. It's being put aside till the end of mine life. The oxides in lead zinc are extremely complicated, unlike gold, to process. So we're focusing on the sulfide ore. Drill highlights today. This is the 2017 program. We've drilled 19,000 meters. We've drilled 93 holes. We've released 45 of them. 35 have been in the open pit. On average, our grade has increased by 25% on our open pit intersections. The reason being, we're hitting on about a 75% success rate. We know where the high-grade structures are located within that open pit. The pit itself will be about 1.8 kilometers. You know, it's sort of 18 NFL football fields and 500 football fields wide, or 550 meters. So it's certainly significant. We've also made a new discovery called the Bridge Zone. That's right by our open pit Burke Hinge, and it connects our two open pit zones. I hope to be able to demonstrate to the market later this year that we've added between 750,000 tons to 1.2 million. I think that's the potential of that zone. It's the highest grade we've hit to date. We're hitting holes that are 13, 14% lead zinc. It would be part of the underground program, but it would be the underground program that's mined first. It's just a pushback from our pit wall. So this would be mined in probably years 11, 12, 13. The share price. Since we put out the new resource, we've been consolidating. We've almost tripled the resource. The grade has gone up by 25% on our published holes since then. We found a new zone, but we've kind of maintained the same market cap, which is around $24 to $25 million. Unfortunately, the only thing that I've got left to blame, it's management. So that's incumbent on me, and you know, really that'll be my job moving forward, is to bring the valuation up as we put out further drill holes. So just in wrapping up, the next 100 days, expect further results from our open pit drilling. We've got a news release out. We're hoping to get it out on Tuesday, but expect 3 or 4 more before December. We're going to take a brief hiatus in December, stop drilling. We'll be back in around beginning of April, maybe the end of March. We're also drill testing a key copper hit that we got last year. We're 2 kilometers from the lead zinc ore body at Pegmont. We hit 3 meters of 3% copper, half a gram of gold. Different type of geology. The drill's turning on it now. We should have an indication in the next couple days whether we have a second ore body or if it was just a one-hit wonder. We're doing our geotechnical work so that we can come out with a PEA in 2018. And we're going to do further metallurgical work and our baseline environmental studies as well, and look for a new resource in January or February of 2018. So just in closing, since we've picked up the project, we've tripled the size of the ore body, or will shortly. We've increased the grade. We're reducing the strip ratio. We've now got some institutional following with Industrial Alliance. So I think things are definitely moving in the right direction. If you have any questions, I'll just be outside at the booth through the doors there. Thank you very much.